to a Wall Street Journal reporter, Veronica Dagher. We've got market watchers David Kotok and Larry Glazer. All right, Veronica, whether it happens in this conversation or in the next hour and 45 minutes or so, or before the end of the day, it seems to be given that it's just a matter of time. The 20,000 is within reach. Then what? What do you think?
Well, you know, it's a tough time for average investors because they're looking at these massive gains, especially if you've looked at your 401k lately. You're probably really excited, more excited than you've been in years, but you're not sure what to do. A lot of the financial advisors I speak to say stay the course, stick to your long-term financial plan. You may be looking at wanting to take some gains off the table, do some tax loss harvesting. If you're an investor, think about that. Think about because taxes are probably going to be higher next year. But in terms of what average investors should do, don't panic, don't get too excited. You know, we're going to see more volatility going into next year, so this isn't something we can say, oh, sure bet straight up all the way, because we're going to see more ups and downs.
But, you know, David, I could see at least the down part of the significant downdraft part till next year when, if you're an investor and you're looking forward to lower taxes, that is when you would be doing your selling, not now when rates are prohibitively higher. But what do you make of it?
Well, I think you have something going in that description in terms of a possible post-January 1st change that could be a downdraft. We took some off the table, Neil.
Did you?
We have a little cash reserve. We had a marvelous run. It's been a fantastic year, and my grandfather taught me you don't get hurt when you take some profits, so we took some now.
All right, so are you still, what's your breakdown? Are you still mostly in this market, having said that, or just waiting it out?
We have a cash reserve of approximately 15%.
Wow.
That's very recent. All that was established within the last week. We still like the energy sector. We still like the banks and the financials. We like the tech sector. We would stay away from interest sensitives here, like utilities.
All right, that's interesting because Larry Glazer, it's widely assumed that tomorrow the Federal Reserve is going to wrap up its two-day meeting by hiking interest rates, first time in a year, and maybe set the stage for more such hikes. This time, the markets don't seem to care, or am I missing something? What do you think?
No, I think you're right. Look, investors are sniffing out the fact that we might be in the most pro-business economic climate going forward since the days of Ronald Reagan. And it's so amazing that we could see Dow 20,000 just as the Fed is actually raising rates and moving off of this 0% interest rate policy that has plagued savers for so many years since the financial crisis. And it is reason for optimism, Neil, because, look, there's about $50 trillion, depending on whose math you look at, in cash on the sidelines. Before the financial crisis, a 6-month CD was paying about 5%. Today it's paying about 1%. So for savers, retirees, people trying to fund education, expenses, it's really good news. And it's also good news because it's money that gets spent in the economy, and the consumer certainly drives the economy. So you made a really good point. People are deferring capital gains. Tax loss selling candidates, weak stocks, become great opportunities this year, more so than most years, but recognize rates potentially are going up. We're in this sea change, and that's good news for everyone except for interest rate sensitive areas and maybe for the real estate sector, which really relies on cheap money.
You know, Veronica, one of the things that happens as rates go up is they tend to slow the economy down if they keep going up. And also it gets more expensive carrying our debt. So whatever economic oomph we get from whatever Donald Trump is going to do is offset by higher rates. Again, the devil is in how much those rates go up. But do you have a worry about that we've made assumptions that this growth will just keep going and will reverse this sort of, you know, subpar recovery, but it might be done in by the very high rates that are addressing that?
That's a really good point. I think so much depends on the Fed and the pace of how they raise and how many times they raise. You got to remember we're starting from a very low base, so for rates to really put a lot of pressure on people, that would take a while. However, if you're mid-income, low-income, you're going to feel those incremental rate changes a lot more than somebody who's wealthy. And so one of the things is you need to remember is that if you're also, this applies to everyone of any wealth level, if you have a credit card balance, do your best to pay that off. If you can't do that, now is the time to look at a lower interest credit card, go for a lower rate so you can roll that balance over. That way you're not getting hammered when rates do go up, because that's going to put a lot of pressure on consumers.
Then let me, David and Larry, let me ask you this final question. For you, David, a young person comes up to you and says, David, I've been looking at this market. It looks really intriguing to me. I've never been in the market. I was leery ever since my parents got walloped in the meltdown. And now I want in because this looks like a party and I don't want out. What do you tell them?
Well, young person, be careful. Stick your toe in a very diversified way, like an index, and don't put all your eggs in the market when it's 19 PE and when you face rising interest rates. The interest rates are going to be important. We've had 8 years of a zero interest rate alternative, and suddenly cash is going to start to earn something.
All right, so Larry, the flip side of that is that these ratios, these price-earnings ratios change. If the economy picks up measurably, then all of a sudden it could seem like a cheap market. What do you tell the same young person?
Yeah, well, look, you don't want to lose your head and recognize the Trump trade, the financials that are running, the industrial stocks that are running, that will be tested next year. But valuation really does matter. So we want to be incremental, recognize that maybe January, February, we get some disappointing news. That'll be an opportunity to put some money to work. Look for bargains in the market. Don't necessarily chase what's running right now. There's plenty of opportunities, high-quality multinational companies that have been left behind in this rally, some big technology names. That's a place to start to build your portfolio. Look through the rubble, look through what people are selling right now, and then buy on weakness into next year. And, of course, be disciplined about it and be incremental.
All right. Thank you all very, very much. Words of wisdom. Much, much appreciated.